This question assesses students' understanding of the components, elements, of the income statement. The keyword "except" is crucial because it asks for the item that does not belong on the income statement. The income statement is designed to report a company's financial performance over an accounting period, including revenues earned, expenses incurred, gains, losses, and the resulting net income or loss. In contrast, shareholders' equity is an element of the statement of financial position, balance sheet, representing the owner's residual interest in the company's assets after deducting liabilities. Students should carefully distinguish between performance-related elements and financial position elements. A. Expenses. Incorrect. Expenses are costs incurred in generating revenue, such as salaries, rent, and depreciation. They are a fundamental component of the income statement because they reduce net income. B. Shareholders' equity. Correct. Shareholders' equity represents the owner's claim on the company's net assets and is reported on the statement of financial position, not the income statement. Although net income affects retained earnings within equity, equity itself is not an income statement element. C. Gains and losses. Incorrect. Gains and losses arise from incidental or non-operating transactions, such as selling equipment or foreign exchange movements, and are reported in the income statement. D. Revenue. Incorrect. Revenue is the inflow of economic benefits from ordinary business activities and is one of the primary elements of the income statement. Correct answer. B. Shareholders' equity. Exam tip. Remember the distinction. Income statement. Revenue, expenses, gains, and losses measures performance over a period. Statement of financial position. Assets, liabilities, and shareholders' equity shows financial position at a specific date. This question tests students' understanding of the purpose of the statement of shareholders' equity. The key phrase is "shows a," meaning students must identify what information this financial statement is designed to present. The statement of shareholders' equity explains how each component of equity changes during an accounting period, including common stock, additional paid-in capital, retained earnings, accumulated other comprehensive income, treasury shares, and other equity accounts where applicable. It reconciles the beginning balances with the ending balances by reporting transactions such as net income, dividends, share issuances, share repurchases, and other equity adjustments. Students should distinguish this statement from the statement of retained earnings, which focuses only on retained earnings. A reconciliation of the beginning and ending balances in shareholders' equity accounts. Correct. The statement of shareholders' equity explains the changes in all components of shareholders' equity during the reporting period. It reconciles the opening and closing balances by showing transactions affecting equity, making this the correct answer. B. Listing of all shareholders' equity accounts and their corresponding dollar amounts. Incorrect. Although the statement includes equity accounts and balances, its primary purpose is to explain changes, not simply to list account amounts. C. Computation of the number of shares outstanding used for earnings per share calculations. Incorrect. The calculation of earnings per share, EPS, is disclosed separately in the financial statements or notes and is not the purpose of the statement of shareholders' equity. D. Reconciliation of the beginning and ending balances in the retained earnings account. Incorrect. This describes the statement of retained earnings, which focuses only on retained earnings rather than the entire shareholders' equity section. Correct answer. A. Reconciliation of the beginning and ending balances in shareholders' equity accounts. Exam tip. Statement of shareholders' equity. Explains changes in all equity accounts. Statement of retained earnings. Explains changes only in retained earnings. Remember that the statement of shareholders' equity provides a comprehensive reconciliation of owners' equity throughout the accounting period. This question tests students' understanding of the statement of cash flows prepared using the indirect method. The indirect method begins with net income and then adjusts for non-cash items and changes in working capital to reconcile net income to net cash provided by operating activities. The key is to identify which item can be directly observed as a separate adjustment on the statement prepared using the indirect method. Students should remember that non-cash expenses, such as depreciation and amortization, are added back to net income because they reduce accounting profit but do not involve cash outflows. A. The payment of interest expense of $200,000. Incorrect. Under the indirect method, the statement usually reports net cash from operating activities, not the actual cash payment for interest as a separate line item. The payment itself cannot normally be identified directly. B. A change in unrealized holding gains of $50,000. Incorrect. Unrealized holding gains may affect comprehensive income, but are generally not shown as a standard adjustment on the operating section of the indirect cash flow statement. C. A settlement of a lawsuit that was previously accrued. Incorrect. The cash settlement affects operating cash flows, but is typically reflected through changes in working capital accounts rather than being separately identified. D. Depreciation related to buildings and equipment. Correct. Depreciation is a non-cash expense deducted in arriving at net income. Under the indirect method, it is added back to net income as a separate adjustment to determine operating cash flow. Correct answer. D. Depreciation related to buildings and equipment. Exam tip. When using the indirect method, start with net income and remember the common adjustments. Add back non-cash expenses, depreciation, amortization. Remove non-operating gains and losses. Adjust for changes in working capital accounts, receivables, inventory, payables, etc. Depreciation is one of the most recognizable and frequently tested adjustments in the indirect cash flow statement. This question tests students' ability to prepare the operating activities section of the statement of cash flows using the indirect method. Under the indirect method, the calculation starts with net income and then adjusts for non-cash expenses, which are added back, e.g., depreciation and amortization, non-operating gains or losses, which are removed, e.g., gains on asset sales, changes in working capital, such as inventories, receivables, and payables. Students should also recognize that cash dividends paid are financing cash flows, not operating cash flows, and therefore should not be included in this calculation. Step 1. Start with net income. $1,500,000. Step 2. Add back non-cash amortization expense. $150,000. Amortization reduces accounting income but does not involve a cash outflow. Step 3. Subtract the gain on sale of equipment. $50,000. The gain increased net income, but the related cash proceeds belong to investing activities, so the gain must be removed from operating cash flow. Step 4. Adjust for the increase in work-in-process inventory. $300,000. An increase in inventory means additional cash was invested in inventory, reducing operating cash flow. Therefore, $1,500,000 plus $150,000 to $50,000. $300,000 equals $1,300,000. A. $1,225,000. Incorrect. This incorrectly incorporates items that do not affect operating cash flow. B. $1,300,000. Correct. This correctly applies all required indirect method adjustments. C. $1,350,000. Incorrect. This likely fails to deduct the inventory increase. D. $1,375,000. Incorrect. This incorrectly includes dividends or omits one of the required adjustments. Correct answer, B. $1,300,000. Exam tip. For the indirect method, remember the sequence. Start with net income plus add back non-cash expenses, depreciation, amortization, minus remove gains, plus add losses, on asset sales plus or minus adjust for changes in working capital. Also remember that cash dividends paid are financing activities, so they do not affect operating cash flows.